Welcome back to the deep dive. Today, we're diving into some financial results that honestly look almost too good to be true. We're looking at Capri Global Capital Ltd's Q2 and half-year FY26 numbers. They're an NBFC, and they're seeing just a massive surge right now. So our mission today is kind of like solving a puzzle. The big headline: consolidated profit after tax it jumped an incredible 143% compared to last year. But their assets under management, AUM, only grew 40%. So we need to figure out the strategy behind that, the leverage, the efficiency. What exactly let them turn 40% growth into nearly triple that in profit?
And we're starting this mission on pretty solid footing. The numbers cover the quarter and half year ending September 30th, 2025. And importantly, the joint statutory auditors gave an unmodified opinion. That's on both standalone and consolidated results.
Unmodified opinion, okay.
Yeah, so it gives us a high degree of certainty here. This isn't just management spin, it's certified.
Okay, good. Let's unpack this then. 143% PAT jump. That's huge. So let's start at the beginning. The core performance highlights. What were those main numbers for Q2 that set this whole thing up?
Well, the first thing, you got to look at the size of the book. Their assets under management, AUM, it crossed Rs 27,040 crores. That's a big milestone.
Right.
And that 40% growth from last September, that's strong. But also it grew 9% just from the previous quarter. So there's definitely some accelerating momentum there.
And connecting that big book size to the actual profit number, a PP is our Rs 236 crores. That's the 143% surge right there.
Exactly. And to make that happen, to support that growth, the operations had to scale up massively. Disbursements, that's the actual cash going out to borrowers, they grew 64% year over year.
64%.
Yeah, reaching Rs 8,952 crores in just the quarter. It tells you their operational engine can handle some serious volume.
Okay, but massive volume, rapid scale. Often that eats into efficiency, doesn't it? This is where it gets really interesting for you, listening in. What did it actually mean for their return on capital?
This is the critical part. Their return on average equity, ROAE, it jumped dramatically, went from 9.8% a year ago up to 14.4% this quarter.
Wow, okay, big jump.
Huge jump. And at the same time, return on average assets, ROAA, that surged too, from 2.3% to 4.0%. So for you, the listener, this means management is squeezing out way more profit from every single rupee of shareholder money and every asset they hold. It's not just volume, it's quality, profitable volume.
Which sets the stage perfectly for what's next. We know management isn't just going to sit back at 14.4% ROAA. The promoter and MD, Mr. Rajesh Sharma, he's set this really ambitious target, hasn't he?
He has. Rs 50,000 crores in AUM by FY28. That's almost double where they are now. And crucially, they're targeting an ROAE of 16% to 18% alongside that.
And a ROAA of 4.0 to 4.5%.
Right. And that 16-18% ROAE target is key. It signals that even after this incredible jump, they think there's still more efficiency to find, more ways to make their capital work harder. They're telling the market to expect continued improvement.
Absolutely. So let's get into the engine room then. We've seen the headlines. How do they translate that 40% AUM growth into a 143% profit explosion? That's got to be about margins and operational efficiency, right?
Let's start with margins. Net interest income, NII, grew 57% year over year, hit Rs 480 crores. And that growth wasn't just from having a bigger loan book, it was also from better pricing power.
Better pricing power. So are they charging borrowers more or getting cheaper funds themselves? Or both?
It looks like a bit of both, actually. Their blended yields on net advances hit 16.5%. That's up 50 basis points from last year. But importantly, spread the difference between what they earn and what they pay for funds, that was 6.9%, also up 50 basis points.
Okay, so they're managing both sides well.
Exactly. They're booking higher yielding loans and managing their funding costs effectively. Shows real strength in their treasury operations.
And what about income that isn't from interest? The fee income side, that seems to be really taking off, which is great for diversifying revenue.
Oh, absolutely booming. Non-interest income surged 97% year over year. Came in at Rs 203 crores. It's now contributing almost 30% of their net total income. That builds resilience, like you said.
So where's that coming from specifically?
Well, they're clearly getting better at monetizing their customer base. Take insurance distribution. They've got partnerships with 18 different companies now. That brought in Rs 19 crores in net fees just in Q2.
And the car loan distribution partnership, that seems to be scaling well without them needing to put up all the capital themselves.
Precisely. They originated Rs 2,830 crores in car loans in the quarter. That's up 14% year over year. And it was all facilitated through 13 partner banks. It fits their strategy perfectly. use relationships to generate high-margin fees that complement the main lending business.
Okay, but if we're talking about a 143% profit jump, we absolutely have to talk about operating leverage. I mean, that has to be the single biggest driver here, surely.
Without a doubt. This is where the real magic happened, the cost-to-income ratio. It just plummeted, dropped to 49.4% in Q2. Now compare that to 64.3% just a year ago.
Wow, 64.3 down to 49.4.
That's a strategic gain of 1481 basis points.
Yeah.
In just 12 months. It's massive.
1481 basis points. Just spell it out for the listener. What does that mean in practical terms?
It means the company hit a kind of tipping point for efficiency. They spent a lot of building out their network, right? They added 86 branches just this quarter, bringing the total up to 1,224 locations.
Okay.
So what that huge 143% profit spike tells us is that this massive network, which was a big overhead cost maybe a year ago, is now running much closer to full capacity. They're pulling in way more revenue over largely the same fixed cost base.
Yeah.
It's like they're finally getting the massive returns on that big network investment.
Okay, so we figured out how the efficiency gains, the margin strengths. Now let's look at the where. Which specific loan products are actually driving this 40% AUM growth? Where's the fuel coming from?
Yeah, the growth was definitely concentrated in segments known for higher yields and quicker turnover. The absolute leader was gold loans. That segment surged by an aggressive 58.1% year over year.
58%.
Yeah, it was 10,406 crores.
Okay, gold loans are up almost 60%. That's huge, but it's also one of the most cutthroat competitive spaces out there for NBFCs. Is this just pure volume, or are they doing something different on pricing or speed?
It seems mostly volume-driven, but it's backed by that operational efficiency we just talked about. It lets them process loans maybe faster, maybe cheaper than some competitors. Alongside gold, affordable housing grew a very strong 37.0%. That's nearly our 6,000 crores now. And construction finance was up 48.5%.
Okay. And MSME?
MSME grew too, but at a more, let's say, measured pace, solid 17.7%.
Yeah.
So the real accelerators here are clearly gold and affordable housing.
Right. Now, connecting this AUM mix back to the ROAE target we discussed earlier, we need to talk about co-lending. That feels like a really vital piece for an NBFC trying to hit high ROE numbers.
Oh, it's absolutely central to the strategy. Co-lending is, well, it's clever. It lets them originate these high-quality loans, use their expertise, but then partner with banks to sell down a big chunk of the loan.
So they get fees up front.
Exactly. Fees up front, and crucially, they free up their own capital almost immediately to go out and lend again. It's like a capital recycling shortcut. Lets them turn their money over much faster, which is essential for hitting those ambitious ROAE goals.
So how big a deal is this co-lending strategy becoming in their overall book now?
It's becoming very significant. The co-lending AUM reached IRS 5,677 crores. That's up 61% year over year, even faster than the overall AUM growth.
61%, wow.
Yeah, and maybe more revealing, it now makes up 21.0% of their total consolidated AUM. That's up from 18.9% just in the previous quarter. So management is clearly choosing speed and capital recycling over just holding every single loan entirely on their own books. It's a textbook modern NBFC strategy for capital-light growth.
Okay, this brings us to a really critical question, though. When you see growth this fast, 40% AUM, 64% disbursements, your first instinct is often to worry about risk. Was this growth reckless? Did the quality of all those new loans suffer?
And the answer there is probably the most impressive number in the whole report. The exact opposite happened. They actually improved asset quality while they were accelerating growth.
Really?
Yeah. The gross stage 3 ratio, basically the gross NPA, declined to 1.3%. That's down 36 basis points from last September.
That's fantastic discipline, growing the book and cleaning it up at the same time. What about net NPAs?
Net stage 3 ratio also improved, down to 0.7%. That's a 25 basis point improvement year over year.
Yeah.
And what's more, they're actually carrying a bigger safety cushion. Their provision coverage ratio, the PCR on those stage 3 loans, increased to 42.8%.
Oh.
That's nearly 300 basis points more capital set aside against potential losses than they had a year ago. Better quality, bigger buffer.
Right. But that kind of scale up, that kind of growth needs serious capital fuel. Let's look at their balance sheet strength. How strong are the capital buffers needed to keep this pace going?
Oh, they are extremely well capitalized. Their standalone capital adequacy ratio, CRAR, is very robust at 32.9%. And that's actually a big increase year over year, up 916 basis points.
900 basis points.
Yeah. And total consolidated equity is now Rs 6,673 crores, up 66% YoY. So they absolutely have the balance sheet muscle to keep pursuing those aggressive targets.
And on the debt side, funding that growth. We saw some recent activity there that kind of confirms the market's confidence, didn't we?
We did. The regulatory filings show they successfully completed a public issue of non-convertible debentures and CDs for RSS 400 crores.
Hmm.
And critically, it was oversubscribed. That's a really strong external vote of confidence in their strategy and how they're managing risk.
And no issues with compliance on those debentures.
Nope, complete compliance. The security cover certificate confirms they're maintaining cover at 1.36 times. All the debt covenants were met, timely payments, and importantly, no rating downgrades. All clean.
Okay. So before we wrap up the pure numbers, we should probably touch on the bigger picture. Growth and profit are crucial, obviously, but how is this company thinking about long-term sustainability, the whole ESG framework?
Yeah, and this is actually an area where they seem to be differentiating themselves strategically. They participated in the S&P Global Corporate Sustainability Assessment, the CSA, for the first time ever, and they got a score of 49.
Okay, 49. Is that good? How does that compare?
It's actually very good for a first attempt. It significantly beats the industry average, which is around 30. So it suggests they're well ahead of many peers in building a more sustainable business model.
That's a pretty big gap versus the average. Any specific areas where they scored particularly well in that assessment?
Yeah, the scores were notably high in financial inclusion. They got a 75 there, and also in business ethics, where they scored 79. And this lines up really well with their stated focus on social impact.
Right, because they're core business.
Exactly. Their core business, lending for affordable housing and to MSMEs, inherently aligns with some of those sustainable development goals, like no poverty and gender equality. And they make that explicit by noting they empower over 1.5 lakh women borrowers.
Okay, so if we pull this whole deep dive together, what's the sort of core takeaway for you, the listener?
I think the steep rise in profitability, that really eye-popping 143% PP jump, boils down to a powerful three-part strategy. First, you had aggressive AUM growth, but specifically in high-yield areas like gold loans and affordable housing. Second, they really diversified their income streams with that surge in fee-based income. And third, maybe most importantly, they unlocked significant operating leverage. That 1481 basis point improvement in the cost-to-income ratio is proof. And they did all this while improving asset quality and keeping capital buffers strong.
So what does this all mean for you as you watch Capri Global going forward? Well, management's targeting that 16% to 18% ROAE range, but right now they're at 14.4%. So to bridge that final gap and hit their ambitious goal of doubling AUM by FY28, what comes next? What new operational efficiencies or market shifts, maybe even more co-lending, perhaps deeper tech integration in that huge branch network, what will be needed to squeeze out those final 2 or 3 percentage points of return? That feels like the defining question for their growth story over the next couple of years.